Start off by documenting assumptions in an organized way. Reading in the problem that we're going to buy a Ford F-350 for $47,000. That is a balance sheet investment. We purchased the long-term asset. You are going to need to borrow that entire amount, which is also going to be an interest-bearing transaction. So we're going to need to take out some debt. The debt is going to be equal to the amount of the truck. And then additionally, that debt is going to have an interest rate associated with it, 10%. When you see that interest rate, then you know that not only are you going to have debt, but you will have the impact of debt as being new interest expense. And that interest expense we can calculate in a while by looking at the debt and the interest rate together. Additionally, the truck should last for 5 years. So that's a useful life as measured in years. 5, let's cozy that up next to the truck itself so that we have everything organized in a thoughtful way. The truck should last for 5 years and be depreciated. So that will be a salvage value of $5,000. And then we have a new variable in here, which would be the resale value, meaning not the accounting salvage, but the dollar amount we think we could get by selling it into the market. Now let's think of the impacts of these things. So you're going to be able to plow snow in the following amounts for the following year. So let's drop this information over here. Let's understand that we're now dealing with revenues, and specifically the revenues are going to be tied to the number of driveways we can plow in any given year. Each driveway has a price associated with it, and the price, as it was indicated above, is $30 per time that it snows. And in this model, we are going to expect it to snow every year or every season 10 different times. And the nice thing about setting the spreadsheet up like this is then as things change, we can go ahead and update our assumptions to be more dynamic. Additionally, cost of goods, which would be things like salt and gas for the truck, cost of goods are going to consume a certain percentage of our revenues, and the problem suggests that that's 55%, where SG&A is going to be 22%, again, as calculated as a percent of revenues. Those would be things like marketing expense or insurance expense or the like. We know that we bought capital equipment, so that means there's going to be depreciation. So in any given year, we'll have the truck's cost minus its salvage value divided by its useful life. And then if we put F4 on all those terms, that should allow us to estimate that depreciation amount each and every year. Interest expense is going to be the amount that we borrowed, which we can fix, times the interest rate, which we can also fix, which suggests the $4,700 a year. And interest expense tells us that we're missing at least one or two things, which is a corporate tax rate of 33% that will apply to our earnings each and every year. And then last thing, a rate as an opportunity cost of capital of 11%. The income statement for the 5 years for which we will own and operate our snowplow business. Revenues, expenses, cost of goods, gross margin, gross profit, sometimes I like it better, SG&A, EBITDA, depreciation expense, EBIT. In this one, we will have interest expense, earnings before tax, tax, net income. All right, so in year one, our revenues would be equal to 300 driveways that we plow. We get $30 every time we plow them, and we do it 10 times a year. If we copy and paste that because of the dynamic referencing, we could see, for example, in year 5, it's 400 driveways, $30, 10 times a year. Cost of goods are on a percent of revenue basis. So 90,000, we pay 55% of that in cost of goods. And again, the relative form in this case suggests that last year we pay 55% of our $120,000 in revenues. Our subtotals, revenues minus cost of goods sold. How about SG&A? Again, it's a percentage of revenues, where SG&A represents 22% of revenues, whereas cost of goods represented 55%. And again, the relative referencing allowed us to see the formula when we copied and pasted it. Gives us EBITDA as our next subtotal line on our income statement. The depreciation we had calculated up above and can just pull that number on down. Gives us then our EBIT. We have interest expense that we calculated up above as being $4,700 as a result of borrowing to buy the truck, which gives us then our EBT number. And lastly, we have to pay tax at a rate of 33%, which we put every year. And that allows us to predict what our profits might be by running the snowplow business. Just copy and paste that across, put a nice underline underneath it. So this is what is going to happen in order for us to see the income statement impacts of our balance sheet purchases. So now let's look at whether or not it makes sense as a good investment from an NPV point of view. So we're looking at 5 years where we'd have cash flows in and cash flows out, and cash flows net and present value, net present value, and IRR. So first year, we get 90,000 in revenues. Copy and paste that across and see that in year 5 we get 120. Our cash flows out in any year are the cost of goods that we spend money on, plus the SG&A that we spend money on, not the depreciation, but yes to the interest expense and yes to the tax. And the relative setup of the formula allows us to see in year 5 the change in our cash flows out. So that cash flows net in any year is cash flows in minus cash flows out. So we see the net cash flows that we would generate of being more than $81,000. How were we able to kick this project off? Well, we had to go ahead and lay out $47,000 to begin with in the very beginning. So what are the present values of each of those? Well, at a rate of 11%, which is only sitting there once, so I will fix it there, when it's right now that with no payment, so we double tap the comma to move through the payment field, and then point to negative cash flows net as your future value. Suggest that $47,000 out now is $47,000 on a present value basis. Copy and paste that across, and then, for example, looking at E37, our rate of 11%, looking 5 years out, switching the sign on cash flows net, we see we have good numbers declining for present value over time. So the net present value is going to be the sum of all those present values. So we see we have a good project in terms of generating new marginal profit for us. In the IRR, we use the function in Excel by highlighting all the cash flows net and equals IRR. Do that again. You see we get a project that yields about a 20% return and a positive NPV of just south of $12,000. The last thing that we need to do is incorporate the fact that in year 5, we also had a resale value for the truck itself of $7,000. That's not something we're going to put through the income statement. It's going to be just a straight cash flow, which according to the problem 2, we are not going to worry about any tax on that. So in year 5, when the cash flows in, we're going to add on that additional $7,000 in resale, so that in the end, factoring in that additional cash flow from resale, we end up with a $16,000 plus NPV and an IRR of greater than 22%.